Welcome to Rent or Die, the podcast where we break down the truth about real estate, property management, and building wealth. Whether you're a seasoned investor, an apartment building owner, or maybe you're thinking about getting into rental real estate, we've got the insights to help you win in the rental game. Thanks for tuning in. Let's jump into today's episode. All right, let's get into this. I wanted to talk today a little bit about something that's been in the news recently. And it's pretty much the talk of the town in the mortgage industry. It's the 50-year mortgage. So what's more typical in residential real estate is you have a 30-year mortgage. And I'll be honest with you, like sometimes you wonder, am I going to be able to pay this off in my lifetime, depending on, when you got the loan, how old you are, how long it took for you to ramp up and get prepared to buy, that type of thing. So I wanted to talk a little bit about this potential rise of the 50-year mortgage. And I've been on LinkedIn and I've heard chatter about lenders experimenting with longer term loans, pitching it, beginning to pitch these as, hey, this isn't so bad. But I think there's definitely some upshots, and then there's also a lot of downturns. So we have to ask ourselves, is this a good idea, or is this a financial trap kind of dressed up as affordability? So let's break it down a little bit. So first off, a 50-year mortgage is exactly what it sounds like. It's a home loan that's stretched over 50 years instead of the typical 30-year mortgages, which is the U.S. standard. Now, in commercial real estate, you see a variety of loans. Typically, though, you're looking at 5, 10, 15, 20, sometimes 30-year loans. But, I think it's a rarity to see a 40-year loan. 50, totally unheard of. So I guess Pulte had pitched this to the president, and suddenly it was seeming like we were going to be running with it. To the, I guess, the objection of some of the White House staff, according to media sources. So, well, let's talk about the pros. I mean, we're here. Something worthwhile to talk about. The first thing, obviously, is by stretching the loan, kind of like your car loan, right? When you go to the dealership, sometimes they're like, hey, you can take, you could have a 5-year loan, a 3-year loan, a 7-year loan. It's kind of the same shtick, right? But you end up with lower monthly payments, so it becomes a lot more affordable. Which nowadays, over the past several years, we've seen the skyrocketing of home prices, and now as rates are starting to cool off a little bit and go down, the question becomes the affordability of, can people even purchase homes because the prices are so high. So this is a way for the market kind of to circumvent that and keep the static or the velocity of sales happening. And it's just simply going to make it more affordable for people who are cutting it close or are currently priced out. If somebody is qualified, a longer term loan would reduce the costs, thus making the buyer have a little bit more firepower or increased buying power when they go out to purchase a home, which matches nicely because the home prices are pretty high. I would predict that ultimately the home values would rise, definitely in the near term, because you're going to have lower rates. So we're going to see the people who are renting apartments come out of the apartments in a lot of cases, because we know rents are absolutely sky high right now. So rents are high. Rents are high, and so I think there's this pent up demand on the buyer side, where people are like, look, if I can get into a home, get the tax advantages of owning a home, I certainly want to do that. I want to pursue the American dream. And I believe a lot of those cases exist in apartments nowadays. Who doesn't want a backyard, right? Although if you have too big of a backyard, I'll tell you, it can be hard to maintain from time to time. So yeah, I mean, a longer term might let buyers qualify for more expensive homes, not because they make more, but because their payment fits the lender's debt to income ratios, pretty much. So cash flow, if cash flow for investors. So let's say you bought a 4 flat, and you have 20 or 30-year mortgage on it, right? So you're collecting rents now, and suddenly there's an opportunity because you bought last year or 2 years ago. The rates are a little bit higher. Rates are coming down, but now they're also willing to extend your payments by almost double. And so your payment's going to go down. So for an investor, what this is going to do is this is going to allow them to create more monthly cash flow within their building. They'll probably refinance to a lower rate, save some money there. And then because of that, that extension of the amortization schedule, you're going to have less monthly payments due, thus have more cash flow. Which in a perfect world, that sounds great, right? Like, who doesn't want more cash flow? So there's also a theory that if your payment stays fixed while inflation rises, that debt becomes cheaper to service over time. So it's almost like an inflation hedge, if you will. So some of the downturns, though, I think are super important is, and I'll be honest with you, they sound like some really mega downturns. Not just saying, if you're giving out 50-year loans, I mean, you could also at the same time, if you wanted to go full out, just reduce the borrowing age from 18 down to, let's say, 12 years old, right? That way you can, give a 50-year mortgage and keep that person all the way through their retirement age in the same house. Though that's a joke, but I'm just saying it does seem like it's a little bit. I don't know. I'm not really when I think about my own kids, I'm not too excited about this because firstly, they're going to pay a ton more interest over the life of the loan. And with a mortgage, you actually start paying off that mortgage, right? Building equity. And that's what everybody has always said. Hey, get into a house, own a house. One of the big benefits is you're not paying a landlord. Money is coming off of your principal every month. Well, in this case, the money coming off the principal is going to be a whole lot less than if it were 30 years. So usually the first 10 years or so of a mortgage is pretty much mostly everything's going towards the interest. You're basically like renting from the bank with the hope of catching up later, right? And so usually, let's say over a period of time, let's say a business cycle of, I'm just going to say 20 years, okay? Because apparently, I mean, it seems that way, right? Like we're entering back into that beautiful business cycle of 2002, 3, all that. So I'm just going to tag it with 20 years. So over a 20-year period, you can have a downturn in the market, and as long as it's affordable for you, you don't have any major life changes, loss of jobs, things like that, and you can continue paying your mortgage, usually the market will, there will be an upswing, just like there has been recently, and you're going to recover and actually profit. And while you had been paying down your mortgage, you have some good equity there. So you have the distance between what you owe, which has been suppressed by you paying every month, to what now you can sell it for. And since the market would be back in an upswing, that would be a good time to potentially exit, right? So there is a negative equity risk, though. And so the negative equity risk, and this is what people have to think about or contemplate, is that the market is not always rosy, and certainly the market is not static. It definitely changes. And so that negative equity risk is like, if the market goes down or there's a downturn in the market, now, let's say you bought a house for, let's say, $500,000, and the market gets wiped out and drops by 20%, now your home value is 400,000 and you owe 500,000. So now you're kind of stuck, right? Unless you're gonna, drop another 100 grand into it and get your equity, back below your debt. And of course, I'm just saying like all this in round numbers, not including down payments and things like that. But even if you did come in with a down payment, your down payment can get wiped out and you could still end up with negative equity, because if it drops from 500 to, let's say, 375 or 350 or 300 or 200, you're still stuck, right? And people might say, well, that's not going to happen. We'll go back and look in July 2006, it started falling. 2007, by 2008, the thing was just wiped out, and things in some neighborhoods were selling for anywhere between 10 to 15% cheaper, and in some neighborhoods 90% cheaper, right? So I don't know, this generational debt mindset. It's like it's a cultural shift to me, and you might never actually own your home in your lifetime. So you end up, I don't know what the plan is. You're going to end up passing the mortgage baton to your kids instead of having like something that's paid off that you're going to pass on. It just seems off to me, this 50-year mortgage. Now, I'm a broker, so I can see the value to doing it, right? In the near term, right, it's very short-sighted. It's like, when a child wants to eat a bunch of candy and they just eat all the candy they want, well, guess what? They're not thinking that they're going to go to the dentist and he's going to find all these cavities, right? But that's kind of what's going to happen here is people, it's good for me as a broker. There's going to be velocity, a high churn of mortgages, but I'll never say that I believe a 50-year mortgage is going to be healthy for somebody, although it's just simply, in my mind, another tool in the arsenal of lenders and realtors to get somebody who otherwise would not qualify into a house. So let's do a deal, right? And so the only way that this thing sticks, I think, over thinking of the politics and the churn that happens there, is if they put these out here on a mass scale, okay? Because I don't doubt that somebody's going to be able to go several years from now, do a retrospective and say, hey, that was super predatory, right? A, we're not going to do that anymore. Or B, we have to somehow compensate those people that ended up buying houses, right? They can avoid all that based on capitalism pretty much, just by making it totally widespread and systemic. So I'll tell you, if you're thinking of buying a property, I guess now would be a good time if you believe that this is going to happen, because that velocity and that taking people out of the apartment buildings into residential houses, that is definitely going to raise the prices. There's no doubt about it. The more buyers you have, the higher the prices go, and you might actually see, so maybe not a run-up. I could envision a situation where you had kind of like a plateau of values, and just kind of like thinking in terms of demand for purchasing, and then supply, where people, who are sitting on, 2.5% mortgage, they are not moving because the rates are so incredibly high, along with pricing, though, right? So, these things are just so complex in terms of all the different positions that everybody has and their different interests in different perspectives and things like that. So for us, like, if you come to me and say, hey, Adam, I talked to a lender, I got a 50-year loan, I want to go out there, I'm going to take you out there and sell you a house. But I am going to talk to you about, how to maybe get into it, and, the risks that exist in the market, and then thinking also about a potential exit strategy on that loan. So there are some scenarios where it makes sense, and one of those is like if you're young, you plan on staying in the home long term and you value cash flow over equity, or if you're an investor prioritizing cash on cash returns and you're taking some of that cash and putting it into a bank, that's a different story. I won't get into that. But I get the use cases, but I also play something advocate and just say that a lot of times when you are young, you look forward and you say, I'm never going to move from this house. I'm never, ever going to leave. This is my forever home, right? And then, life keeps happening. It happens to everybody. Life is one of those things that just seems to keep, moving along. And sometimes it goes against what you want. Because you know why? That's life. Even Frank Sinatra said it. There's a song, That's Life, I'm not a very good singer, but I'll say though, I don't know. I think the 50-year mortgage might make the dream of home ownership look affordable, but it certainly doesn't make it cheap. It trades today's comfort for tomorrow's leverage, and that's a deal you really have to think carefully about. So if rates stay high, lenders might experiment more with these. I wonder how available they'll be as rates go lower, because that's a commitment from the bank to get their demand deposits out there, and there's some risk for them too. So, but they did get a bailout before, right? I mean, a lot of these banks did get a bailout last time this thing went wrong. So, give me a call if you have a chance to subscribe to the podcast, whether you're digesting it on Amazon or Spotify or YouTube. I'd appreciate it if you could go to our Facebook page and give us a like. It's Westmont Realty. It's got fireworks in the logo. I would appreciate that as well. And that's it for this session. So thanks a lot, and we'll be talking soon. Stay tuned. Thanks a lot. All right, that's it for this episode of Rent or Die. If you enjoyed the show, make sure to subscribe, leave a review, and share it with somebody who needs to hear this. Got a wild landlord or tenant story? Hit me up. I'd love to feature it on the show. You can email it to vetshopcustomercare@gmail.com. Again, that's vetshopcustomercare@gmail.com. Thanks for tuning in, and I'll catch you next time.